Financial feasibility. Financial feasibility means it is an analysis which determine if a project or a investment is going to be valuable or it will generate profit in return. It involves examining cost, revenue, and other financial factors to assess project's ability to cover the expenses and the potential profit. Components of a business plan. A business plan or model describes how an organization creates, delivers, and capture value in economic, social, and cultural context. A business plan is a document that details the organization's strategy and expected financial performance for year to come. And sales plan is a strategy document that lays out a company plan for improving sales result in a specified time period. It requires you will take calculation of market size top down and bottom up approach and conduct the following step. Build a sales forecast, create a customer acquisition funnel. A financial plan is a comprehensive picture for your current finances and your financial goals and strategies to meet your financial goals. Steps in the financial plan are calculate setup cost, forecast profit and loss, work out your cash flow projection, forecast your balance sheet, find your break even point. Sales plan forecasting. A sales plan consists of a sales forecast and a plan to achieve the forecast. And sales forecast is a projection of the number of units of product or service you want to sell even in a given time period. Sales planning is divided into two parts. Forecast your sales for next 1 year. Plan the number of leads you will need to meet your sales target. Forecasting. While completing your forecasting, refer back to the two approaches we have employed in week 2, top down and bottom up. Use bottom up approach to arrive at a realistic estimation of market size. Create a yourself forecast from there while ensure that you take into accountability of your capacity and ambition. You can employ several forecasting methods such as lead driven, length of sales cycle, intuitive, test market analysis, historical forecasting. Customer acquisition funnel. Customer acquisition is the process of gaining new customer. Acquisition funnel is a place or process where you can turn your prospect into actual customers. This is a crucial step into venture creation. Hence, you need to do analysis of your target customer very carefully. Make sure you have enough prospect leads at each stage of funnel so that enough remain at next stage. At the product and service front, once the prospective customer signs up with you, you must ensure that your customer is able to connect with the actual product and the promise made in the unique value proposition blocks of your business model are met. About 80% of your customer will come back from your target segment or niche, but there may be outside the target segment also. So keep on your eyes on that. Make sure you follow up the customers and take feedback to make further enhancement on to your product or service. This this delights the customer and there are chances that you get more customers and referrals. If your conversion rate is high, then what you should concentrate on is to increase the number of people entering that stage of your funnel. So ensure that you have enough number of people at this stage of the funnel, which is ultimately generate the revenue for your business. And the last stage of the funnel is customers. The customers are very crucial in this stage where you get paid. So ensure you have enough number of customers at this stage of the funnel, which is ultimately generate the revenue of your business. People plan. Before you begin working on people plan, find out what skills you are already have in the team. Consider the following question: does the existing team have technical ability to build the product solution? If yes, how many people units of the product and service can they build in a month? Does the existing team have a sense of how the industry operates and what value your product and service can add in this industry? Is your existing team capable of handling the packaging and delivery of your product or service? Do you have anyone to handle the accounts, manage your payments up into supplier payments from customer salaries? Here are few some guidance to create your people plan. Number: how many people you need to achieve goals that you have set for your sales plan. Hiring: consider hiring people as consultant rather than as an employee. Are there any roles who, who you may need for a limited number of months or for a limited number of hours in a week? Skills: list the skill you need for a team members you want to hire. Budget: set a budget for a sales for, set a budget for the salaries offer, pay packages industry standard, neither too low neither too high. Research the kind of salaries people draw from a particular skill set and experience level. Salary calculator site like salary.com and know your worth to find out what salary you can afford to give. Here are few ways to find the right talent for your organization or startup. Look for potential custom candidates for your venture among your own contacts. People who join new ventures need to trust the founders of the venture. So if the candidate express interest, you will already have a connect and trust. Use social media platforms such as LinkedIn to find good talent. Also leverage the network of existing employees to find and hire new people. Find a good balance of youth and enthusiastic and the experience and mature in your team. Financial plan. A financial plan is a forecast of the future performance for a business and in the third part of business plan. This includes planning your expenses and how much plan to sell your profit and how you plan to spend your cash meet your expenses. A financial plan will help you plan and optimize your expenses such as startup costs, fixed costs and cost of goods. Plan and manage your cash flows and effectively estimate your income and profits. Essential components of financial plan. Startup cost. Startup costs are the expense incurred during the process of creating a new business. Example of startup cost include licensing, permit, insurance, office supply, payroll, marketing costs, research expense and utilities. Forecast and PL. A profit and loss forecast shows your company expected revenue and expense over a given period, demonstrating whether you can expect make a profit or a loss over the coming months. Cash flow. Cash flow is a measurement of amount of cash that comes into your business in a particular period of time. Cash flow is a statement help to track and analyze, determine and liquidity or and solvency of your business and health. The cash flow is required to fund your payroll, cover or your heads and pay your suppliers and purchase equipment. Unit economics and key metrics. Economics describes a specific business model, revenues, and cost in relation to an individual unit. A unit refers to any basic quantitable item that creates value for a business. Thus, unit economics demonstrate how much value each item or unit generates for this business. Step 1: define your unit. For an airline, a unit might be a single sold, whereas the ride share app would be unit as one ride in the vehicle. These units are analyzed to determine how much profit or loss they individually produce. Some business require to multiple unit of measure. For example, an infrastructure service provider that has geographically distributed physical infrastructure, data centers, cloud, wireless towers have significant capital investment for its deployment. As a result, this business should be used each and unit of physical infrastructure, their core unit and within reach. Use a customer unit as a secondary unit. Step 2, calculate cost of goods sold. Calculate your cost of service sold. Step 3, calculate customer lifetime value LTV. How much money business receive from a given customer before the customer churns or stop doing business with the company. Customer acquisition cost, the cost of attracting client or customer for the startup. And the customer lifetime value. Customer lifetime value is the average value of the sale into number of transaction into retention time period. Higher the lifetime value, the better it is for the business. Step to increase lifetime value. Increase average value of sales, margins need to go up, number of transaction to increase, retention time period to increase, customer needs to be engaged. Customer acquisition cost. Customer acquisition cost is equal to the total expenses to attract, engage, and convert a new customer divided by the number of customer acquired. Cost and revenue. Startup costs are those who will occur before you start your business. Fixed costs are the ones those your business sustain regularly regardless of production and sales. This is usually calculated for duration of a month at a time. Variable cost. Unlike fixed cost, variable cost will depend on the rate of production and sales. Pricing can be determined by the process of pricing your venture is center to profit making. The key to finding right price is to make your product pricing retain customer while still make your profit. Profit is equal to revenue minus fixed plus variable cost. Fixing your price will depend on your customer segment, which is already covered in depth before. Depending your customer segment, you can select a particular pricing strategy to suit both customer and your venture. A pricing strategy is largely divided into three types: maximization, market penetration, market scheming.